With the economy sliding along from behind tinted glass and closed doors, Federal Reserve Chairman Ben Bernanke thinks he has the bandage to help this economy, with the Fed lowering a key interest rate by 1/4 point to 2%. This is a more moderate reduction after a string of hefty cuts. The hope is dropping rates stimulate spending. So far, a slumping housing market and credit problems are forcing most consumers to hunker down. New statistics from the Commerce Department indicate the economy is growing, but only slightly, less than 1%. So no recession, at least according to economists, but not according to consumers.
I work in employment and staffing, so I see kind of how the downturn's coming around and things like that, and it frankly concerns me a lot.
Consumer spending is at a crawl, rising at a 1% pace, the slowest since 2001 when the country was in recession. Soaring prices for food and energy have people closing their pocketbooks. Lower rates may not do much for the housing market, where falling home values have people feeling less wealthy.
I think we're still looking at a housing market that, from all indication, is still very weak in terms of homebuyer demand. And I think the Fed needs to worry about that going forward, particularly the momentum in house prices.
The Fed started cutting rates last September, but may be nearing the end of its rate cut run, trying to avoid inflation, with core prices, excluding food and gas, rising more than 2%. Cause for inflation discomfort at the Fed. Lee Powell, The Associated Press.